Hi, this is Chris Marabella, Net Lease TV. It's Thursday, October 19th, 2023, and we're going to be listening in on Fed Chair Powell's economic outlook that starts right at 9 a.m. So we're just waiting for him and the presentation to start. Right now, 10-year Treasuries at 493, could possibly hit 5%. Fed's mandate is still 2% inflation. And so this is important to net lease finance. Right now, we're seeing rates anywhere between 6.5% to 7.5% for net lease financing. So we want to keep continuing to monitor Fed Chair Powell's economic outlook. That should start shortly. So let's stay tuned. Let's see how it goes and see what he's saying about the federal funds rate, inflation, and other things, and if they're going to, again, raise rates.
Great feedback at the Economic Club in New York, where I last visited before COVID. So before our discussion, I'll take a few minutes just to discuss recent economic data and the outlook for monetary policy. Incoming data over recent months show ongoing progress toward both of our dual mandate goals: maximum employment and stable prices.
So they're trying to get to 2% inflation. Sounds good.
Raised rates in March of 2022, it was clear that restoring price stability would require both the unwinding of pandemic-related distortions to supply and demand, and also restrictive monetary policy to cool strong demand and give supply time to catch up. These forces are now working together to bring inflation down. After peaking at 7.1% in June 2022, 12-month headline PCE inflation is estimated at 3.5% through September. Core PCE inflation, which omits the volatile food and energy components, provides a better indicator of where inflation is heading. And 12-month core PCE inflation peaked at 5.6% in February 2020.
So it sounds like inflation's coming down in the 3% range.
So clear progress there. Inflation readings turned lower over the summer, a very favorable development. The September inflation data continued that downward trend, but were somewhat less encouraging. And shorter-term measures of core inflation over the most recent 3 and 6 months are now running below 3%.
So that's good news, below 3%.
These shorter-term measures are often volatile, and in any case, inflation is still too high. And a few months of good data are only the beginning of what it will take to build confidence that inflation is moving down sustainably.
So 10-year notes still right around 493.
We do not yet know how long these lower readings will persist or where inflation will settle over coming quarters. While the path is likely to be bumpy and to take some time, my colleagues and I are united in our commitment to bring down inflation sustainably to 2%. In the labor market, strong job creation has met a welcome increase in the supply of workers through both the higher participation and to a rebound of immigration to pre-pandemic levels. Many indicators suggest that while conditions remain tight, the labor market is gradually cooling. Job openings have moved down well below their highs and are now only modestly above pre-pandemic levels. Quits are back to pre-pandemic levels as well, and the same is true of the wage premium earned by those who change jobs. Surveys of workers and employers show a return to pre-pandemic levels of tightness, and indicators of wage growth show a gradual decline toward levels that would be consistent with 2% inflation over time.
So that sounds good.
To date, declining inflation has not come at the cost of meaningfully higher unemployment, a highly welcome development, but also a historically unusual one. Healing of supply chains in conjunction with the rebalancing of demand and supply.
We don't have all those
has allowed disinflation without
container ships off Long Beach anymore. It seems like our supply chain's much better now.
Surprise to the upside this year, as most recently seen in the strong retail sales data released earlier this week. Forecasters generally expect the GDP to come in very strong for the third quarter before cooling off in the fourth quarter and next year. Still, the record suggests that a sustainable return to our 2% inflation goal is likely to require a period of below-trend growth and some further softening in labor market conditions. Geopolitical tensions are highly elevated and pose important risks to global economic activity. Of course, our institutional role at the Fed is to monitor these developments for their economic implications, which remain highly uncertain.
Well, to keep an eye on the price of oil here.
Personally, I found
we're about
on Israel
almost 1 year before the election here, so Biden's going to do everything he can to get the price of oil down, but he may not have that ability with all this instability in the Middle East and Israel.
525 basis points at a historically fast pace and decreasing our securities holdings by roughly $1 trillion. The stance of policy is restrictive, meaning that tight policy is putting downward pressure on economic activity and inflation. Given the fast pace of the tightening, there may still be meaningful tightening in the pipeline.
So they may tighten down the line, and he just said.
My colleagues and I are committed to achieving a stance of policy that is sufficiently restrictive to bring inflation sustainably down to 2% over time, and to keeping policy restrictive.
So we may see another increase of the federal funds rate coming up.
We are attentive to recent data showing the resilience of economic growth and demand for labor. Additional evidence of persistently above trend growth or that tightness in the labor market is no longer easing could put further progress on inflation at risk and could warrant further tightening of policy. Along with many other factors, actual and expected changes in the stance of monetary policy affect broader financial conditions, which in turn affect economic activity, employment, and inflation. Financial conditions have tightened significantly in recent months, and longer-term bond yields have been an important driving factor in this tightening.
Again, 10-year note, 493, could go to 5.
Because
we'll see.
Financial conditions can have implications for the path of monetary policy. My colleagues and I remain resolute in our commitment to returning inflation to 2% over time. A range of uncertainties, both old ones and new ones, complicate our task of balancing the risk of tightening monetary policy too much against the risk of tightening too little. Doing too little could allow above target inflation to become entrenched and ultimately require monetary policy to wring more persistent inflation from the economy at a high cost to employment. Doing too much could also do unnecessary harm to the economy. Given the uncertainties and risks, and given how far we've come, the committee is proceeding carefully.
That's good.
We will make decisions about the extent of additional policy firming and how long policy will remain restrictive based on the totality of the incoming data, the evolving outlook, and the balance of risks. Thank you. I look forward to our conversation.
So there you go. Jerome Powell's testimony today, Thursday, October 19th, 2023. Sounds like he's still hawkish. Potential federal funds rate increases in the future. We got the 10-year note right around 493. Rates right now for single multi-tenant net lease right around 6.5 to 7.5, depending on credit quality of the tenant, guarantor, remaining lease term, location, use, and other factors. If you're in need of net lease financing, give me a call and text me on my cell, 760-803-6464. And there you go, Jerome Powell's testimony today. Thanks again for watching Net Lease TV.